Hey everyone, Sumit Roy, Senior Analyst at ETF.com here, and today we're talking meme stocks with Dave Mazza, who's the CEO of Roundhill Investments. Dave, great to see you.
Hey, great to see you as well. Thanks for having me today.
Absolutely. So, Dave, this week you did something that we don't see very often. You resurrected a dead ETF. The Roundhill Meme Stock ETF, ticker symbol MEME, came back to life after shutting down in 2023. Why did you decide to bring this ETF back to market, Dave?
Yeah, well, I think it's, to my knowledge, the first time an ETF issuer has done this, relaunched an ETF with the similar concept and same ticker. But there's a few things that have really changed since we originally launched Meme, closed Meme, and have now relaunched this particular fund. So one is an appreciation of the structural force that retail investors play in today's market. So I think there was an original thought in the original meme craze, or when retail really first became a force in markets in the COVID period, that it was going to be cyclical. But now what we've seen actually is that, retail participation is on any given day, an up day, a down day, a flat day, 15 to 20% of the overall US equity market. We also know that, retail investors have frictionless trading with transaction-free platforms, with real-time access to information that they never had before, and really the broad-based ecosystem of communities that exist out there. It's no longer just Wall Street bets. And so when we reflected on this and sort of saw the lasting force that retail can bring, it really got us thinking about reintroducing meme, but in a different way. So the original fund was actually passively managed, rebalanced twice a month. But this particular version is an actively managed ETF, and we're using information about the implied volatility of stocks to screen the universe, and then introducing social sentiment scraping and other research to help augment that to identify a basket of stocks that we believe are reflective of meme stocks or the potential for stocks to meme.
Yeah, I want to talk a little bit more about the strategy in a second, Dave, but you touched on some really interesting points, and it is crazy to me as well, because back in 2020, 2021, when we first saw meme stocks emerge with GameStop, AMC, etc., everyone thought that was just a pandemic era phenomenon. It was going to go away as soon as the economy reopened. Yet here we are 4 or 5 years later, and it has reemerged in, some would argue, an even bigger form. That's kind of crazy. This meme stock phenomenon wasn't just a pandemic era thing. It's a thing that's going to stay with us going forward, potentially.
Yeah, and I think sort of what is a meme stock has evolved as well. And some of that is, I think, because of the growing sophistication of retail coupled with, those important structural elements that I mentioned a moment ago, is that, we know GameStop, AMC, it was like a rebellion, right? It was Main Street fighting against Wall Street, going after the hedge funds and the big boys with short interest on stocks that they knew and loved and had an affinity for. And of course, Roaring Kitty personified all of that. But since that time, meme stock investing has really evolved. And if we look at it thematically today, and in the MEME ETF, there's healthy exposure to quantum computing, which has been a theme that retail investors have really gravitated toward. AI adjacent names, crypto companies in every way, shape, or form, and then actually even a rare earths company is in meme today, because those are the stocks that retail is most focused on, right? GME and AMC aren't in the portfolio because they're no longer, while they're the OGs, are no longer the meme stocks of 2025.
Yeah, you certainly don't hear about GameStop nearly as much anymore. So, Dave, you mentioned this is an actively managed ETF, with contrast with the old version of the ETF, which was based on an index. Could we maybe just compare and contrast the two strategies to see why you have changed it and what makes this one superior? I was looking through the old information you put out there on the previous version of Meme. And essentially, you looked at something called the social media score, or the amount of activity, comments, likes, etc., that stocks were seeing on the internet. Then you took the stocks with the highest short interest and you put those in the portfolio. In contrast, now you're looking at trading volume as your first big screen, and then you're looking at implied volatility, which is essentially the options market's expectation of how much a stock is going to move in the future. So, can you talk about why you switched from looking at social media scores to start, and now you're looking more at implied volatility and trading activity?
Yeah, so the social media scoring was robust, and then it identified companies that had a high amount of sort of conversation and interest on social media. But what that had the ability to do was finding corner solutions. So companies that may have a lot of social chatter, but aren't really meme stocks or stocks that have the potential to meme. So it brought a universe that was certainly relevant among retail, but not necessarily in the way that we believe most would think about meme stocks. And so that's why we pivoted to active management in this particular case. One, which I think is important, is just simply the dynamicism of the portfolio. So it's going to be rebalanced at least on a weekly basis, if not more frequently, to capture meme stocks as they emerge. And in this case, we are also, to your point, using quantitative measures to help sort of first and foremost guide that universe of stocks, right? So focusing on stocks with high trading volume, and then using the options market to then identify a narrower universe of companies that have high implied volatility, which is often indicative of stocks that are associated with memes. And then we kind of further that with our qualitative framework to really then ensure that the basket, which will be relatively narrow, is going to be reflective of stocks that are meme stocks and avoid the potential for corner solutions.
Yeah, it almost seems like you kind of flipped the strategy. Before you're looking at the social media activity first. Now you're narrowing it down with the implied volatility and you're looking at the social media stuff at the end using your judgment. Is that right?
Yeah, I think that's a fair assessment of sort of the. I hadn't thought about it from the flipping standpoint, but I'm gonna borrow that.
Yeah, so now I'm looking at the portfolio. You mentioned some of the names that are in it, Dave. We got Rigetti Computing, 12% of the portfolio, QuantumScape, Bloom Energy, Oklo is also a big holding. So it certainly, fits what we're seeing out there in social media. A lot of retail favorites in there. You could say, they're speculative stocks, but they're also stocks focused on real serious businesses, which is different than the 2020, 2021 meme stock craze, which some people have kind of considered a joke. Buying GameStop, it was kind of funny. Do you think that's changed, compared to the last meme stock boom? And do you take that into consideration at all when you're picking the final portfolio? You try to avoid kind of the joke meme stocks and buy the more serious ones?
Yeah, well, it's interesting. So I think the original meme craze was really almost about sort of identifying companies with a lot of controversy or broken companies in some way. The GameStop sort of scenario being a prime example, and investors both sticking it to the man, but then also saying, "Hey, this is a company that we believe sort of could have a future, and it's not maybe as broken as the marketplace thinks it is." In today's world, while there is open doors in the portfolio, that company doesn't necessarily have a broken business model. It has ones that need some catalysts to actually kind of build its momentum. And then if we think about sort of whether it's the AI related names or the nuclear name, Oklo that you mentioned, is that these are really kind of companies that have the potential for hyper growth. So while there's some speculative nature with some of their business models and their technologies may be unproven, they're really about sort of latching on to the potential for future transformation as opposed to sort of fixing something that's wrong with the existing business model.
So, who should consider buying this ETF, Dave? Is it people who buy meme stocks? Instead, they should look at this ETF, which holds a basket of meme stocks. Is it people who never buy meme stocks, but they want to kind of capitalize on the whole meme stock phenomenon? Who is it for?
I think there's really kind of two first primary use cases, and there are actually maybe others. So one is, yes, the cohort of investors who are interested in meme stocks and want to continue to invest in those individual securities, but also get access to a professionally managed basket of meme stocks for the diversification potential of that narrower universe of meme stocks. But it's also, and we've been having some interesting conversations with investors on this topic since we filed for MEME, and of course, when it launched this week, is that there's a group of investors who really, one, believe in sort of the thesis that retail can be very powerful, but two, also view it as a risk factor. And this is not a risk factor that we think about with a growth stock versus a value stock or a large stock, a mid-cap stock, a small-cap stock. It's that the factor is retail, and they can move markets. Now, the markets they're moving may not be the mega cap stocks, but it's kind of the cohort of companies that you find in MEME. So it allows a broader cross section of investors, if they're interested in accessing the kind of factor that retail favorites and sort of meme stocks can play in the market. And then over time, I think depending upon as the fund continues to grow, and it's in its early days, but the market reception has been particularly strong, is that there could be actually an institutional use case to access these particular companies because they're not necessarily going to find them in the majority of their positions, or someone could use it as a hedge in some ways against other positions that they have in their portfolio.
Super interesting. Final question, Dave. You kind of touched on this. We went through this cycle where we had the meme stocks blow up in 2020, 2021, then they kind of fell out of favor. But we also talked about how it looks like this is a force that's here to stay. Do you still think there's some cyclicality when it comes to meme stocks? There's going to be a big wave higher than a downturn eventually. And if that's the case, where do you think we are in that cycle today? Because I know the last version of the meme stock kind of had unfortunate timing. It launched in December 2021, right as meme stocks were topping, and they fell significantly in 2022 as the Fed raised interest rates. What do you think about all that?
Yeah, there's a lot to unpack there. I think, again, first and foremost, retail investors, we believe, are a structural force in U.S. equity markets, if not global equity markets, especially in countries in Asia. And their influence matters to a much greater extent than it ever did before. But how they sort of evolve and identify different themes or different companies that they believe in is really important, which is one of the reasons why we thought active management was absolutely necessary to reintroduce the MEME ETF. And then at the same time, I do think we've seen retail investors in some ways actually be the outperformers in 2025. They bought the dip in April, unlike sort of traditional institutions and hedge funds. And so under some metrics, retail is winning this year. Now, I'm not sort of downplaying the fact that if we were to see sort of a material, longer standing downturn in the economy or the market, that may change people's interest in investing, as we've seen, since we've been in a pretty persistent bull market for the recent past. And so, but I think absent sort of that, because of the way that particularly younger investors, millennial and Gen Z, view investing as part of their lives now, I don't really see them going away as maybe we saw with the initial episode with GME and AMC when people were stuck at home during COVID.
Dave, super interesting ETF. We're going to be following it very closely. I want to thank you for taking the time today to explain the MEME ETF to us.
Thanks for having me.